Hey traders, this is Blake Morrow with Trader Summit, and I'm super excited to have with me for the first time in a long time. I have Mr. Mark Dow. He's ex-hedge fund manager, but also really, he controls the Behavioral Macro Twitter handle. But more importantly, he manages a lot of money in a big family office. And Mark, it is such a pleasure to have you back on Trader Summit. How are you been?
Thanks, Blake. Thanks for having me. Doing pretty well. Doing pretty well. Thanks.
You know,
Good to see you.
I'm going to say this just because I've known you for literally about a decade via social media, maybe more. Um, I've been following you, and I always try to follow your work as closely as possible. There are a few people out there in the Twitter sphere that I really hone in on. You happen to be one of those people. And what I noticed over the last, I want to say, year and a half, really 2023, going into 2024, when everybody was very bearish from a macro perspective, you were really one of the standout bulls that I know and I've watched. And I got to ask you this: what kept you bullish, and what kept you from falling into the bear trap last year and going into this year?
Yeah, so for me, it was pretty simple. I was bearish, really sounded the alarms in March, April 2022, and probably started getting bullish around August or September, which was a little bit early. But really, the dominant factor is I just don't fear the Fed rate hikes and quantitative tightening the way everyone else does. I knew that going into 2022, we had bubble type behavior in a lot of sectors. We had SPACs and we had coins, and you know Tesla was going to the moon, and ARK, everybody wanted a piece of that. So that was happening, and that was clearly the kind of behavior that needs to pop and needs to cool down. And 2022 did that, but we got to a point where the Fed kept raising rates, trying to get inflation down, and people got increasingly worried about what that was going to do to the economy, and they started talking about the inverted yield curve and the effect of rates with a lag on the economy. And for me, for both secular and cyclical reasons, I just didn't think it's nearly as powerful as everyone else did.
So why did okay? For two questions, I guess here. First of all, do you still think there is a lag? First question. Second question is going back to your earlier comments. Why are you not afraid of the Fed, and why do you think that it just didn't matter in this cycle? If you
Yeah. So I think for the secular reason why monetary policy isn't as powerful as people think is because the the system has changed fundamentally. It used to be, I mean, goes back to the history of money and the Fed. People think that the issuance of money comes from the Fed, and it can, but it primarily comes from banks, chartered banks. So the way it works is a bank, they want to lend you some money, Blake, and they say, okay, we're going to give you a loan and we're going to credit your deposit account for the same amount. They don't need reserves from the Fed. They don't, as long as they're within their prudential ratios, capitalization ratios, and liquidity ratios, they don't need anything. To do that. That's their license to print money. Now, the world has changed, so that still exists, but there are a lot of other channels, the shadow banks, and the repo markets and the euro dollar markets, through which dollars can be created out of thin air without any Fed involvement. So basically, the percentage of the global money, of the global dollar supply that the Fed has a fairly direct control over, has shrunk significantly. And also the way banking takes place, lending takes place, people lend at a spread. You can, if I want to make you a 10-year loan and I just care about the spread, I can short a 10-year treasury or sell a 10-year swap and hedge at that point in the curve, so I'm not taking duration risk. So I wasn't afraid of the inverted yield curve, and I wasn't afraid of the Fed tightening monetary conditions for those, or at least I wasn't as afraid for those secular reasons. Cyclically, we know that people came into, households and the financial sector in particular, very importantly, and the corporate sector came into this cycle with much better balance sheets, either because they had refinanced, because they learned from the last crisis 10 years ago or 15 years ago now, and we were in much better shape. And you always joke you can't commit suicide jumping out of the basement window, right? And you need
Right.
to really get hurt and to get into kind of a recession, you typically have to be levered up. Either the corporation has hoarded a lot of labor and they've invested a lot and they've got debt that they've got to repay, and households are margined and levered up to the gills. Something happens and triggers fear and go, oh no, I might get hurt because I'm so leveraged, and you get a forced deleveraging. Well, if you're not levered up to begin with that aggressively, you don't have to. You can look at events a little more calmly, and you can act in a more timely manner. So not everybody's rushing for the exit or because they have a fire extinguisher in their hand or whatever the proper metaphor would be. So for both secular and cyclical reasons, I didn't fear the inverted yield curve the way everyone else did, and I certainly didn't fear shrinking the balance sheet, and to a lesser extent, I feared the higher interest rates. Obviously, there's a level of interest rates that can do damage, right? And we didn't know where that was, and maybe we got close. I don't know, but I wasn't nearly as afraid as other people were. The wall of maturity, the wall of maturities for the commercial real estate sector, all that kind of stuff. I thought that was much more manageable than everyone else did. So that gave me some confidence once I saw in October of 2022 what looked like a good bottom, a good kind of washout bottom. I wasn't afraid to step in, and since then I haven't seen anything that has scared me off of that. Yes, there have been moments where I've been tactically cautious or bearish, but I haven't been fundamentally bearish for a while. Not even after the bank crisis, if you want to call it that, of March 2023. I thought those were mostly one-offs. The Fed stepped in to short circuit the panic, as they should, so everyone can assess. Okay, they short circuited the panic. Everyone took a look around, and they said, okay, there are a couple of banks that need to be wound down, and a couple of other banks that just need a liquidity bridge. We'll take care of that, and we move on. And that's kind of what we're doing. So I just haven't been afraid, and that continues to be the case. I just don't think there's that lag. Monetary policy has a lag, right? But the lag is so specific, both in terms of its length and in terms of its power. It's so specific to the conditions at that point in time that you can't really generalize. People like to say, 12 to 18 months is the lag. You just can't make that average. There's just too much dispersion in that sample. And in this particular case, for the reasons I mentioned, it wasn't very powerful. So that's basically been the story.
Mark, with this cycle, if you will, I guess we call COVID a cycle, right? With this cycle, there was a lot of fiscal, stimulus that hit the market, and you're talking household corporate balance sheets were already, not in bad shape, but then you add all this fiscal to the mix. I mean, it's just kept this cycle going and going and going. I will ask you what you see as maybe some risks moving forward. And I'm going to ask that here in a moment, but I actually want to bring up another topic, because this is something that you and I, briefly discussed before hitting the record button, is that I've always known you as a precious metals, I say precious metals, I'd say a gold bear. And and you're always on the other side of gold, saying, yeah, it's not going to go higher. But you said recently to me, privately, you've turned bullish and constructive on precious metals. Can you explain to people why?
Let's do that. I want to go back to the fiscal thing real quick, and then we'll move on to gold, because this is important. I think that people don't look at fiscal the right way. The way in a crisis, the way you should look at fiscal is you get hit with a shock, and it creates kind of like, you basically have a line on a graph that, over time, what GDP looks like, or what economic activity looks like. And it's kind of a line that goes from the lower right to the lower left to the upper right gradually. But if you get a shock, you get a big U, a big dip, it's like a big hole. And fiscal fills that hole, right? Now, it could overfill that hole, as you could argue it did this time. Or it could underfill the hole, as as it did arguably after the global financial crisis of 2008. But most of it goes to fill that hole. And that's how you should look at it. So it helped accelerated the decline of the unemployment rate back to something good from something really bad. And that gives people confidence that things are going to be okay and I can return to my normal risk taking in my business and in my life. Because if you don't feel like your situation is secure, either because your balance sheet's not in good shape or because your job might be at risk or your business might be at risk, you're not going to take risk, and that furthers the spiral. So the fiscal, I don't, didn't contribute that much to inflation, although obviously without it, we would have had less inflation, but we would have had a lot more unemployment too, right? Yeah. But the combination of coming in with good balance sheets and fiscal filling that hole, plus or minus a little bit, I think is really what put us in great shape for this attenuated cycle. Now, for gold, I have a different thesis than most other people. You often see, and I remember this from 2009 very clearly, we were coming out of the crisis, stocks were starting to rise, treasury yields were starting to rise because there was a scramble for treasury bonds when basically when we had the financial crisis in 2008, people needed safe assets and they needed to recapitalize and improve their ratios. The financial system did, and everyone else wanted to go with what was safe, right? So treasury yields declined sharply, and then as the economy started to recover, yields started to go higher. But part of the reason we started to recover was because there was big fiscal spending going on, right? They were trying to fill that. They were trying to fill that hole that had been caused, that shock to aggregate demand that had been caused by the global financial the global financial crisis. Gold also started to rise. Now, the usual correlation to gold is real interest rates and sometimes nominal interest rates. But the gold standard, if you were, of indicators for gold is real rates. So real rates were going higher, but gold was going up. Every time that happens, there's a contingent of people, they're kind of the fiscal scolds and the debt warriors. They say, you see, the only way gold can go higher when rates are going higher is if they fear the deficit is not and the debt is not sustainable. They're losing confidence in the United States and all those, those stories. We're hearing those stories again.
I was going to say today, right? That's today.
We're hearing those stories again because rates are going hot. Rates have been going higher. That correlation has broken down. Rates are going higher and gold is going higher. However, the idea that they're losing confidence in the United States is belied by other factors such as the stock market and other things. But be that as it may, that's the story. That's the story right now. But what's really happening to me is you look back at when the correlation started to break down. So in 2009 into 2010, it was fairly brief, and then it ended. There was enthusiasm, enthusiasm stuck with gold for a couple more years because everyone was pointing to the money printing. They said, look, they're doing, and QE was a novelty then. They said, look, they're doing QE. You know what that means. Sooner or later, with a lag, it's going to hit us and we're going to have an explosion of inflation. So that kept that story alive for a little longer. In this particular case, we kind of know QE isn't as powerful as everyone thought when it first came out. But we saw the correlation broke down in the run-up to the Russian invasion of Ukraine. Why would that be? Because Russia knew it was going to what it was going to do, and it knew the U.S. could and would likely respond with sanctions on dollar deposits that the Russian entities have around the world. Right. So that happened, and the correlation broke down. And then after, of course, the invasion, and the U.S. did apply sanctions, froze deposits. A lot of state and non-state actors around the world looked at what was happening and said, you know what, that could happen to me. So I need to diversify out of dollars as well. Now, the pool of dollars around the world is so large that you can't possibly diversify in a large way, a Russia or a China or a Saudi Arabia or whoever it happens to be. But they will try. They'll do what they can at the margin, and a small amount from the global dollar pool going into the gold market is a big amount of money for the gold market. So for me, that's what's been driving the relationship. And then, of course, once everyone else notices, us traders, guys, monkeys like us, we see, oh, look, gold's going up and rates are also going up. There's something going on there. I smell that. I'm going to jump on this trend. So now you have CTAs and you have trend followers and you have momentum getting involved. But the underlying phenomenon is these state and non-state actors are afraid that the dollar could be weaponized against them one day and need to at the margin diversify. So I think that's really the story that's going on. It's not about inflation coming back. It's not about losing confidence in the dollar or the because of the debt burden or what have you. And you can look, if you look around, the dollar's doing fine against the euro, the dollar's doing fine against the yen. So it's not that people are losing confidence in the dollar. It's at the margin. They're taking a small amount of money out of a large dollar pool and putting it into a very small pool, which is the gold market.
So that's the really fantastic point. And I think that people understanding why you're more constructive on precious metals at this point, especially specifically gold, that makes sense. But does that apply to crypto, and how do you see the crypto market? Because I think people would argue that that crypto, it fills that void for some investors that gold does, as a more of a safe haven, a shielding asset, if you will, and maybe a deleveraged dollar play, if you will. So how do you feel about the crypto market?
I think that's a different phenomenon. I don't think Russia and China and Saudi Arabia and whomever else is diversifying into Bitcoin. I just don't think they're doing it in any meaningful way. I think what's happening there is it's more like a video game. I mean, we live in a new world now, and a lot of people who grew up with electronic trading and playing video games, and they look at Bitcoin and go, oh, cool, this is like online poker. People are trying to make it something, but it still really doesn't have a use case apart from a couple of really niche things, that people talk about. But it was never the currency it was promised to be. It wasn't a store of value. It's not the inflation hedge, all those kinds of things. It's not, but people are playing the game, and now there's a lot of infrastructure built into that. They've raised companies and they have ETFs now, and so there's some structural inertia to that. But I don't think it's serving the purpose that gold is for as a diversifying asset at the margin for these other guys. You can see in the correlations, gold behaves differently to the NASDAQ than Bitcoin. Bitcoin correlates much more tightly to risk assets than gold does, right? Even though gold at times also correlates with risk assets, but not in the way Bitcoin goes. So I wouldn't draw that parallel.
Okay, and so but you would believe, and I don't want to put words in your mouth here, but do you believe the crypto markets, specifically, let's talk Bitcoin and maybe Ethereum and a couple other names, they're here to stay because they are part of society, part of the Wall Street machine, if you will? Do you think they're here to stay for the most part?
They'll be around for a lot longer. They'll be around for a lot longer until people get tired of them. But maybe it's just something that stays around as a speculative vehicle, the way online gambling does, right? I mean, online gambling is around. Guys are betting all the time on every single sporting event. It seems like I get enough action in the markets. I'm never, I put $20 into the March Madness pool and the World Cup pool, but that's about it for me. But a lot of guys are into it. So, is that going to stay? Yeah, probably. So I maybe it does, but for me, I'm going to be a functional skeptic until I see some kind of technology that's compelling. And I like to say, and I've seen this, the killer apps, the ones that make something really useful, are the ones that you're forced to adopt because they make your life so much better that you say, I'll go through the technological hoops to figure out how to do it because I know that it will make my life that much easier. We don't have that for Bitcoin.
Yeah.
And there's a fundamental tension between making it easier to access and protecting the properties that Bitcoin advocates claim it has, of being not centralized and hack proof, all those kinds of things, that it's safer. The safety of it comes from having to jump, in part, from having to jump through those hoops to get in it. But yeah, my dislike of my fundamental dislike of Bitcoin and gold both come from the same notion that what underpins the bulls of these assets is a flawed understanding of monetary policy. It's often conspiratorial, and it's often distrustful in a way that basically they propagate stories about monetary policy that are not only untrue, but they damage the credibility, unnecessarily damage the credibility of the institution. And I'm a guy, I used to work at the IMF. I was a policy economist at the Treasury as well. And I've been all over the world and climbed into all kinds of economies. That's political economics around the world is what I did for the better part of my career. And I can tell you what distinguishes us from all the other countries is the quality of our institutions, right? And if people are gratuitously debasing them or trying to foment distrust in our institutions with no proper grounds, that's not good. That all of a sudden we lose our advantage over other countries. So that's why I fundamentally dislike them. But like I said, there's a story behind gold now that I think is true. And when I saw the charts start to line up in a bullish fashion, then I said, okay, I might dislike it, but it's going up.
Well, speaking of which, before I go, I want to talk a little bit of what you do at Behavioral Macro, because one of the things I can appreciate about what you do and what I've been watching of you, and we've had conversations and interviews over the years, is I appreciate the fact that you are also not only an economist by trade and understand the macro backdrop and how the markets really operate on more of a deep level, but you're also a technician and you understand what a chart looks like and a good looking chart looks like. So I want to go to behavioral macro in just a few minutes, but I do want to talk about one more subject before we go. And this was more about where we currently stand with the Fed and expectations and where you might see the 10-year going and what could really go wrong. Because this year, or let's go back to December of 2023, the market's priced in, 6 rate cuts. Here we are, now looking at maybe 3, possibly 2 rate cuts this year in 2024. But maybe after this week's data, maybe after we get our jobs report and get through CPI, here in a couple of weeks, we might turn around and say, maybe we're not going to get any rate cuts, but it hasn't affected the market. So where do you see rates going, and will it affect the market moving forward? And what could really go wrong in this bull market that we're in right now?
So first of all, the way the market we work in markets is the pendulum swings back and forth between excessive optimism and excessive pessimism, and it's no different for people's expectations about the Fed, what the Fed is going to do. So we went from pricing in a lot of rate cuts to not pricing in so many now. That pendulum is swinging. Maybe it'll swing a little further. I don't know. For me, it's getting close to where it's probably going to stop swinging and start swinging back. But fundamentally, the way I look at where the Fed is right now, apart from the market swings, it is in the distribution, in the tails of the distribution. As long as we don't go to the tails of the distribution, we're fine. And on one tail, we have rate hikes coming back on the table. So if the economy were to run really hot, and if we were to see inflation not just slow down more slowly, but actually pick up again, that would be a bad scenario. People would say, okay, now we don't know where the peak rates are anymore, and that uncertainty would unsettle markets significantly in my mind. Even worse is the other tail, and that is the Fed cuts aggressively because it looks like the economy is sliding into recession. I don't assign a very high probability to that either, but that would be even worse, because I don't think rate cuts can save us from a recession if the economy starts to spin in that direction. If the rate cuts couldn't slow us down, they're not going to save us either. I mean, they'll help, they'll attenuate things probably, but I don't think it'll save us. So as long as we stay out of the tails of the distribution, I think we're going to be fine. The markets are going to go up, markets are going to go down, and we've had a nice run since the bottom in October of 2023. we could retrace. We could have a 5% correction in the S&P, which means more for the stocks you own probably, and we could have that at any point in time for no good reason. So you have to be ready for that. But you have to also take a step back and look. The federal funds rate, what we're pricing in for the end of this year, is the same right now as it was back at the end of October last year when the stock market was at the bottom. So the people have the same rate for the same prediction for the end of 2024, but the stock market is 30% higher. So that tells you this isn't really, yes, day to day, we react as a trigger to what the Fed says or what they might do. But over time, when all that noise trading settles out, the level doesn't make much difference at all to what discounting cash flows and all that stuff. It sounds really nice in your MBA course, but it just it's not there in reality, right? We're 30% higher in the S&P with the same rate for the end of policy rate for the end of 2024. So yeah, as long as we stay out of those tails, and I think odds are pretty good, we'll have our corrections and whatnot, but we should be fine.
Mark, looking at your website, Behavioral Macro, and I want you to talk about this a little bit. But to your point, behavior is something in the markets that I've always found so fascinating over my 25 years of being a market participant. You're like, if we stay out of the distribution part of it, it's kind of like the inflation genie. Like the inflation genie, once it's out, and then it's the same thing with growth or a recession. Once it gets in people's minds, whether it's individual investors, consumers, CEOs of small businesses, which make up a majority of businesses here in the United States, once it's in their mind and collectively that we got a recession, that's when we have a bit of a problem, right?
Yeah, it is. If now getting back to what I said earlier, we have a little bit of a problem. The extent to which people are levered up, they've invested a lot and they've hired a lot, then it's more so. So our balance sheets aren't in bad shape again. So if it were to happen, it wouldn't be good, but it's not going to be tragic. Triggering the financial kind of crises that you and I have come to love over the years. So yeah, it could happen, but I just. More, I would expect a downturn, and it wouldn't be good, but get relative to what we're pricing right now. But I'm not worried about a repeat of 2008 or anything like that.
Gotcha. All right. Well, Mark, tell us what you do at Behavioral Macro, because I love your work, and I'm sure a lot of traders listening in do as well.
Well, thanks. I appreciate that. I basically years ago I had this idea that a lot of people would ask me my opinion and on Twitter in DM and in the open in the open forum. What would you do here? What's this? What do you think about the stock? Or how do you manage this? And I realized that there was also a lot of riffraff and a lot of trolling and things like that. And I said, you know what? I should start a locked account, charge a small fee, and have people sign up who are interested in learning. Younger guys typically, or retail type traders, or and they're professional traders there too, that want to learn techniques to get up the curve. A lot of the guys will be like, they'll be an analyst at a shop, but they want to learn to trade a little bit better. So I use that Twitter handle. Yes, I talk about macro, but I'm pretty brief. I really focus on trade setups, how to think about managing them, how to set stops, how to size positions. And it's about teaching to fish and not giving fish, because people, no matter what they tell you, they want you to give them the fish. They want to say, buy here, sell here. Right. But you don't learn that way. Because you're a trader, you've done this long enough that it's really about knowing yourself. And you don't get to know yourself until you've gone through the process of sweating where you're setting the stop, and sweating the position size and the correlation to everything else in your book. And those kinds of things. You need to go through that process. So I kind of help traders with that. I say, look at these charts. This looks like a good setup, and set out some parameters. And people say, what do you think about this? And I said, well, I'll answer with what I think the problems might be, or whether it looks good or it doesn't look good. So yeah, it's a great little forum, and there's a lot of back and forth. And I get to pass on some of the stuff that I worked really hard to acquire. And hopefully the followers there won't have to work as hard as I did to learn the same stuff.
A lot of sleepless nights. I could feel it. I could feel it already. So, Mark, I want to say this to everybody that's listening. If you enjoyed our time here together with Mark, make sure you give him a thumbs up. Jump in the comments down below and tell him how much you appreciate it. But also, I'm just going to tell you one-on-one. This is our second meeting, with Mark and I over the last 2 days because I had a technical glitch yesterday. So, Mark, from the bottom of my heart and from the Trader Summit community, I want to say thank you so much for spending your time, very, very special time with us today. And I appreciate it. And I'm going to look forward to catching up with you soon. You know, it's been a while since we talked, and I don't want to make it that long the next time that we meet up.
Definitely. I appreciate that, and I appreciate all you do for traders. You know, a lot of the guys on behavioral macro, those kinds of guys, help them get up the curve as well. You do a yeoman's work.
Appreciate it, Mark. And we'll talk to you soon.
Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.